I guess I can simplify it by looking at the 3-2-1 crack spread chart, right? And to go into the start of the view, it is crack spreads ran in a range of 5 to say 12, let's just call it $5 to $12 under normal conditions with abundant inventories and refineries not being forced to run at full capacity. Those crack spreads stay in the $5 to $12 range. With the increase in gasoline demand up against maximum refiner capacity, up against steep curves and dwindling inventories, up against that crack spread going from $10 to $60 at its peak, that is, excuse me, that's the refinery's margin blowing out, right? That's like saying, whatever we pay for Kuppy's newsletter, people are paying double and 3 times and 5 times and 6x. And wouldn't you love to be long Kuppy's company if all of a sudden his newsletter went from a 1x valuation to an 8x valuation? And that's essentially what happened to crack spreads, like I said, because of that scenario between high gas demand, low inventory, steep calendar spreads in oil. The refiners are a constant bid in the oil market because they're earning a $50 return of margin per barrel of oil they're cracking, right? So if you listen to the earnings of the refiners, they've been beating, raising, doing all the things that you want to see in, like I always say, there's a bull market somewhere. And the bull market, in my opinion, is in refineries right now. And unless gasoline demand topples, now gasoline demand has remained on a steep uptrend through this two-quarter GDP lag recession that we've had. And if GDP comes back, gasoline demand globally is going to explode to a new record. And if gasoline demand is at a new record and crack spreads are tight and there's low inventories, then, man, there's only one trade on the board that I get overtly excited for, and it's the refiners.